All right, gentlemen, thank you for joining Danny and I here today.
Glad to be here.
We're happy that we're able to do this. Danny and I have put together videos in the past for our storage owners and operators, and we'd like to put one together today to discuss the capital markets. So as self-storage brokers, Danny and I spend the most of our time in the primary markets throughout Texas, but one of the interesting things that we've seen, and we've kind of touched on some of this relative to the capital markets, is an interest in secondary markets. We recently closed a portfolio out in the Permian in West Texas not too long ago. And this was a unique transaction in the sense that the asset quality was high across the board. There was a demonstrable cash flow that had been very predictable for a number of years. But as many folks who invest and live in Texas, we understand that the Permian is severely influenced by the global oil and gas industry. So we had an investor with a high degree of experience in that particular market, and they used some conventional portfolio lending to get the deal done. What are you guys seeing now that we're talking a little bit about storage, particularly? What are y'all seeing from a leverage standpoint for storage assets that have been performing well over the years? Is it still going to be in the 60 to 65 range for the CMBS debt and maybe more higher leverage for conventional financing?
Well, what I would say to that is from the banks, it's going to be very sponsor driven. Okay. So sponsors, as we all know, there's big institutional sponsors. There's sponsors that have their own management companies that have real-time data that can support adding on another asset within their portfolio pretty easily. Those type of sponsors will warrant a little bit higher leverage if they want that higher leverage, whether it's from the banks or the CMBS market. And so, and it also depends on whether they're stabilized, a value add, or a construction deal. So as much as the market, as much as the product type matters, I think we got to focus on sponsor just as much. And so the CMBS market, as I mentioned, currently is kind of in that 65% range to finance a deal. But we feel like with more product coming out and liquidity starting to open up and more lenders coming out, that leverage point will go up back to the 70-75% arena that it was in order to compete with what the banks are doing.
Agreed.
Danny, you and I are completing a transaction in another secondary market, with East Texas, the greater Tyler area, which is analogous in many ways to Killeen or Waco, or even some of the West Texas markets like Lubbock and Amarillo, and even Midland, Odessa to some extent. Yep. What were the challenges about doing that deal from a capital markets side? When do we expect that property will be, or those properties will be closing, and how long have we been in that process since it's all happening right when COVID reared its ugly head?
Right, so we had a 3-property portfolio that we brought to market out in Tyler and Longview, and we really started marketing right as everything started shutting down in Texas, but that really didn't scare off many of our investors. We had both first-time mom and pops and some of the kind of tier 2, trending more towards the institutional type investors interested in the asset, and we put the deal under contract right under our asking price.
Which was what?
Asking price was about $5.5 million. Okay. So really the only reason why the transaction has been taking a little bit longer to get to the finish line, it doesn't have anything to do with financing. It has to do with the fact that our seller actually has a 4th property that we decided to include into the portfolio after we were in escrow. So on the financing side of things, our buyers were thrilled to get a quote sub 4%, and they've got extra loan proceeds to do some CapEx work that's been deferred for a number of years. So we're expecting to close on that next month in July. And
is that bank financing?
It is.
Yeah.
Yes. They don't like recourse, like you mentioned. Some folks don't, but yep, they got a very attractive quote on that, and they're even happier than they were when they won under contract on the deal.
Yeah, we are. I mean, that's a great example of a success story where there's a flight to quality. So lenders that have either existing relationship with a borrower or wanting to lend in certain product types, they'll get aggressive in order to land into, let's say, a self-storage portfolio. When we go out to the market, we'll go out to the market to multiple lenders, and we'll take data points from those multiple lenders on what product types that they're looking for. And so, we'll look in our database and see that XYZ lender is looking to get aggressive on self-storage. That's the person that we would want to talk to almost immediately, because they're looking to diversify their loan portfolios away from some of the product types that are struggling into self-storage assets.